Hello and welcome back to our Fund Finance podcast. I'm your host, Diana Konrad, counsel at A&O Shearman Luxembourg, and today we have a very exciting topic to discuss: fund finance market insights and future trends. Joining me are three experts in the field: Crystal Zheng, Vice President EMEA Fund Finance at ING Luxembourg; Simon Veron, Head of Client Coverage at RBS International; and Thomas Tomasic, Senior Associate at Dechert Luxembourg LLP. Welcome to the show, Crystal, Simon, and Thomas. Let's dive right in. Simon, can you start by giving us an overview of the current state of the fund finance market?
Thanks, Diana. If I could use one word to describe the current market, it would be dynamic. From our side, we're still seeing strong demand for subscription lines, increasing demand for NAV facilities and GP financing. It feels like a highly competitive market at the moment, which is driving terms as well as more innovation and flexibility in structuring. What's particularly exciting is the early adoption of AI technology, as these tools will help transform how we assess risk, automate documentation and enhance transparency, making fund finance more efficient as fundraising and deal activity picks up next year.
That's very insightful, Simon. Crystal and Thomas, what are your thoughts on the current market conditions?
Well, I echo Simon's comment. We continue to see strong momentum in fund finance market, especially in the second half of 2025. Subscription line financing remains the backbone of fund finance, but the landscape has evolved. Structures are increasingly bespoke, terms are more dynamic and flexible, and we also see increased activity of private credit funds alongside banks. The market still faces macro uncertainties, from interest rate, tariff tension to regulatory shifts. GPs remain focused on liquidity solutions, driving robust demand for NAV financing, hybrid facilities, and continuation vehicle financing. From the regulation front, European bank lenders are adjusting to the lifted risk weight required under Basel 3.1 and being prepared for CRD6, but this has not slowed overall growth.
Indeed, while the subscription line market remains robust, now financing has become main across strategies, for instance supporting secondaries, continuation vehicles, and NAV-backed acquisition. We also see a hybrid facility structures with NAV toggles switching the collateral focus between commitments and portfolio value, as well as accordion features, capacity to upsize. The increase of NAV financing relates to the possibility to provide flexible mid to late life liquidity and to extend the runway to bridge to exits and smooth distributions. We have noticed that in the current market, managers use this mainly for follow-ons and growth, to refinance floating rate debt, bridge to exit, and smooth payouts. We expect the demand in fund finance structures, especially NAV financing, to persist into 2026, shaped by exits and the path of rates.
Interesting points. Now let's talk about future trends. Crystal, what do you foresee for the fund finance market in the coming years?
The recent developments in fund finance market have shifted to more bespoke and flexible structures. We think this trend will continue. More innovative technologies will continue to surface. On the ESG front, the picture is more complex. The ESG fund universe saw record outflows in early 2025 due to geopolitical shifts and regulatory uncertainty. This was followed by a brief rebound and renewed softness later in the year. We see regional divergence has deepened. Europe is tightening ESG rules under SFDR and ESMA guidelines, while US policy reversals have created fragmentation. Despite these headwinds, ESG has become integral to sponsors' investment processes and are used to lenders' requirements. No longer a marketing tool, but a core element of risk management and value creation. So ESG-linked facilities and sustainability KPIs are now common, and investor demand continue to keep ESG at the forefront of fund finance product development.
That's fascinating. Simon, do you have any additional thoughts on future trends?
On the regulatory side, CRD6 is a key discussion point at the moment, particularly amongst banks and lawyers. We need to raise awareness and help clients understand that their lenders will need to be CRD6 compliant especially as we're already writing transactions which will fall into scope through 2026 and 2027. I agree with Crystal on the ESG, and with heightened geopolitical tensions and commitments from UK and European governments to increase defence spending, one evolving discussion linked to ESG is how we adapt to this. With private capital being invested in defence technology funds, and therefore through financing arrangements, lenders will need nuanced policies. But I think the biggest shift will be technology-led. AI is set to play a central role in fund finance, automating covenant monitoring, predicting liquidity needs, and optimising models. I'd expect AI-powered tools will help streamline underwriting and portfolio management, reducing manual processes and creating efficiencies.
Great insights, Simon. Thomas, would you like to share your thoughts on future trends?
Sure. We see three trends shaping fund finance today. The first one is GP financing is increasing due to the fact that exits are slower, carried interest crystallize later, and LPs are asking for higher GP commitments. So managers are borrowing at the GP or management company level to fund those commitments and cover working capital. The second one, private credit is taking a larger role across the ecosystem. Private credit funds are lending directly to funds and to GPs, and they are also supporting banks by purchasing or securitizing portfolio of subscription line and NAVs loans, which helps keep liquidity available in choppier markets. The third one, securitization should continue expanding beyond its core use. It is already standard in Europe for NAV loans and is now moving into subscription line and back leverage structure. Specialist reporting agents are helping borrowers navigate stricter EU reporting rules, noting that managers should remain alert to the risk of re-securitization.
Interesting. Before we wrap up, are there any final thoughts you'd like to share with our listeners?
It sounds obvious, but we must continue to innovate to meet the needs of our clients and the industry. Whether it's more bespoke subscription lines and GP finance solutions, financing for semi-liquid structures and LTIFs, or integrating technology like AI and blockchain, the market is evolving at pace and innovation is the key to remaining relevant.
I agree with Simon. In a market that's constantly evolving and where new challenges present, having a trusted financing partner with presence and deep understanding of the local market is essential to navigate uncertainty, unlock liquidity, create long-term value.
I would like to add that the regulatory framework is also evolving with AIFMD II that is moving towards implementation and should be on the radar for certain key participants, especially AIFMs of loan originating credit fund, given expected enhancement to reporting, disclosure and risk management requirements.
Thank you, Crystal, Simon and Thomas, for sharing your expertise with us today. It's been a very enlightening discussion, and thanks to our listeners for tuning in. Be sure to listen to the next episode of our podcast on subscription lines. Until next time, stay informed and stay ahead.